Why do tech stocks slide when bond yields rise? Where's the petrol gone in the UK? And how do you play the CBA buyback? I'm Peter Switzer, he's Paul Rickard, and we're mad about money. Well, Paul, let's start with this tech slide link between the bond yields going up and tech stock prices going down. How come?
Well, I did say a couple of weeks ago, Peter, to watch the bond market. That would be the clue for the what was going to happen in September. And it's pretty much as I foresaw, Peter. The bond yields have gone up. Markets got a bit nervous. Now, it affects tech stocks more than the rest of the market because tech stocks have more of their price built in terms of future earnings. In other words, when you buy a lot of the tech stocks, we know they're not going to make a lot of money this year, but we're hoping they're going to make money in 2 years, 3 years, 4 years, 5 years, whatever, down the track, right? And of course, to put that into current day dollars, that gets discounted at the bond rate. Now, when bond rates are higher, bringing it back into today's dollars makes it worth less. And so that's where the market gets a bit nervous when bond yields go up. It means in terms of future valuations, they become less in today's dollars terms. Now, that sounds a bit academic, not my idea. But that's how the market's
well, I'm going to ask you some real life normal questions because we have normal people watching this. But all companies' future earnings have a role to play in the stock price. Why are the earnings of a tech company perceived to be that more exaggerated than, say, Commonwealth Bank or whatever? Is it because we know Commonwealth Bank's history a lot better, but we don't know the future of what Tesla's going to do or what Zoom's going to do, or Zip, or Afterpay?
Well, that's part of it, Peter. I mean, Commonwealth Bank is probably growing earnings at 1 or 2% per annum. Tesla, people hope are going to grow earnings at 30% per annum. So there's a lot more built into the future earnings than there is in current earnings. So it's just when you look at the numbers and you value these companies over sort of up to about 10 years, it starts to make a difference once you get that side terms of sort of compound annual growth rate. So that's why it affects tech companies. You're right, it affects everybody. But look, I think part of it is just the market looks for an excuse. And, tech stocks have been the best performing. And so when there's a bit of a sell-off, of course, they get hit the hardest. But that's the academic explanation for why we're seeing tech stocks being impacted by more than other stocks.
And we also should throw in, Paul, not all tech stocks are the same because it's the highfalutin ones like the Zooms, the ones that kind of nowhere. They're the ones that get slugged the most. The Apples and the Microsofts and the Googles can actually defy that kind of relationship.
Yeah, I mean, they're obviously also, they've got a lot of cash as well. So they actually, in one way, could be a beneficiary to having a lot more cash to invest at higher rates. But look, anyhow, we're going to see that the stocks which have got the biggest growth expectations will be hit the hardest.
Okay, let's go to the one. Petrol in the UK. What in the hell? People are going to the Bowser and there's no petrol. What's the story there?
Well, the story here, Peter, is partly Brexit. It's partly a function of not paying enough to the lorry drivers. It's partly a function of COVID, and of course, a lot of the people that drove lorries were from Eastern Europe. They don't want to come back to Britain because they're afraid they're not going to get out again. It's all to do with COVID, immigration, visas, wages, and the rest of it. And I guess
died, haven't they?
Yeah. Look, I guess it just points to an issue that we know is sort of ticking along, and that there is there are some what we call supply chain disruptions at the moment. We know that's the case in shipping. We're now seeing it, and that's a global problem. We know we're now seeing it in places like in the UK in terms of logistics and transport. We know there are even local problems here in Australia, Peter, in terms of getting all the parcels out in time because there simply aren't enough trucks and drivers to take them around. So I guess that's one of the sort of watch points to be wary of. But the Poms, I guess they voted for Brexit. You get what you deserve. And, I'm sure they'll get through it. Boris is going to call in the army, allegedly, Peter.
Yeah. Of course, we feel sorry for the fact that many truck drivers actually passed away. But it's just a confluence of risk management issues that haven't been handled well. But I don't think most people expected the coronavirus to cause these kind of troubles on top of Brexit. Yeah, it's quite an extraordinary story. Let's go to the next one, Paul. The CBA buyback. Now, how should people play this? And it's They've got to basically get their decision made by Friday this week.
That's right. Closes 7 p.m. Eastern Standard Time on Friday. So if you're a 0% taxpayer or a very low rate taxpayer, it's something you should look at. If you're not, don't worry about it. The buyback is just a tax transaction effectively. So get your application in by Friday, 7 o'clock. It will trade at the highest possible discount. So don't even think about tendering 11 or 12% or 13%. This will clear at 14%. That's the maximum discount. If you don't believe me, just tender final price and let the market work it out for you, but it will be a 14% discount. I think CBA is going to stay pretty well bid. We've seen it the last couple of days. It's been going up. The other banks have been slipping a bit. I expect it to stay well bid into the buyback and into next week as people look to replace. That doesn't mean it won't go over the market and fall a touch, but it's going to be staying in hot demand. So if you are looking at replacing back into CBA, you may have to be patient, or get and use dips like today as a chance to buy the stock in anticipation of the buyback. It will be scaled back. That's the question. You won't know till Monday how many shares you get accepted for. And
people who hold, who won't be participating, should they be expecting that the CBA share price could fall substantially, or are you suspecting only a little one and actually could be rebought and therefore drive it up?
Oh, look, it's not going to fall substantially, Peter, because CBA is actually reducing the number of shares on issue by about 4%, and a lot of those are going to be repurchased in the market. So that's why the price is not going to fall. But it is a transaction that works for some people, doesn't work for others. So get your applications in by Friday, 5 p.m. I'd be looking to replace the CBA. I think the gap to the other banks will widen over the next few days. So if you are looking to replace and perhaps reinvest perhaps in National Australia Bank, just be a bit patient there. I think there might be some good buying opportunities in the weeks ahead there.
Yeah, so you think the other banks will actually benefit from other taking their CBA money and buying then?
I think there'll be a bit more selling pressure in the other banks than CBA over the next week or so, Peter, particularly with the market down a bit today. So I think the gap will widen. So if you are looking to reinvest into the other banks, you might find that, just be a little bit patient. The gap might get a little bit wider back for the CBA.
I think people need to read the Switzer report on Monday, Thursday, and Saturday to handle all these complicated issues. I'm Peter Switzer, he's Paul Rickard, and we're mad about money.